In this video, we're going to go over my portfolio, which consists of 9 different income or dividend focused ETFs right on our screen right here. We have XDTE 150 shares, QDTE 160 shares, YMAX, YMAG at 300 shares each, SPY at 125 shares, QQQI 125 shares, WPay 100 shares, and 30 shares of BTCI, which I will be adding more to this position, and ULTY at 150 shares. Now, how has this portfolio performed over the past year? We'll go over that, and we'll let you know my thoughts on how exactly I'm going to rebalance this portfolio, as I do plan to sell out of some of these yield max positions. Particular YMAX has not been performing too well. We did sell out of MSTY or MISTY earlier in the year, which was a good timing because MSTY currently is quite low. And as always, you should always manage your portfolio. These are all actively managed ETFs with an active fund manager doing options trading for you. So you do have to monitor your positions quite closely. And if any of them are not performing as you want to, you will have to move your money into a different fund. Of course, that's not financial advice. We do know that that's what I'm doing for my portfolio. You can't fall in love with any one fund, and that was the case with ULTY. A lot of people loved this fund, and I'm still holding this ETF because they just did a strategy change, which we will cover later in this video. But it did have a reverse split. We can see it's now $40 per share. And overall, that ETF has not performed well. So in this portfolio, we're sitting at $63,500 with about $18,000 in buying power. Now, I normally don't keep this much in buying power, as I usually keep a lot of my uninvested cash in SGov ETF, which is the iShares 0 to 3 month Treasury Bond ETF. It's very tax efficient, pretty low expense ratio of 0.09%, and it has been paying a little over 4% during the majority of 2025. But I do have most of it in a cash position, and we do also have Robinhood Gold for $5 a month. And the reason being is we are getting a 4% interest on our uninvested cash, and with the interest rates dropping, this is now higher than SGov's interest rate, which is actually sitting below 4% at 3.90% as of December 1st. And that is the main reason why I'm utilizing Robinhood Gold's higher interest rate of 4% for this portfolio. And we can see we have been earning quite a lot of interest over the lifespan. We've made about $2,400 off of Robinhood Gold alone, which is quite crazy to think that Robinhood as a platform has paid me that much money. So let's go over our first two ETFs, which is XDTE and QDTE, which are Roundhill's weekly paying ETFs. So XDTE is the S&P 500 0 days to expiry covered call ETF. QDTE is going to be the same strategy, just on the NASDAQ 100 index, but it is going to use a synthetic covered call strategy seeking to provide current income on a weekly basis, while also providing exposure to the price return of the S&P 500 index. So we do have a distribution rate of 37%, and I like the strategy behind this. Even though it is a covered call ETF, they're not holding any options overnight. They're simply selling the options in the morning, closing out at the end of the day. So there is, in my opinion, a little less risk associated with this, but you are going to have a pretty lower, quote unquote, lower distribution rate than a lot of people are used to. But I like this ETF because it does give you weekly distributions, and you are doing it on the S&P 500 index. So unlike ULTY, which has been doing it on speculative stocks and meme stocks as the underlying holdings, this is the S&P 500. Historically, it's going to be a solid index in the long run. If you take a look year to date, it is down 13%. As we did have a pretty steep drop during the Liberation Day in April, but we did see it's been kind of stable ever since. It hasn't recovered all the way back to the $50 price point, but it is sitting in the mid 40s, and you are collecting those weekly distributions. So I am pretty happy with this ETF as a whole. If we take a look at QDTE, we can see it is down as well. It is at $35 per share. It is down 12% year to date, but we do have some pretty good stability ever since April. We can see it is sitting pretty stable, and you are getting a pretty much a little bit higher of a distribution rate just because the NASDAQ 100, or here we're calling it the Innovation 100, is going to be a little bit more volatile of an index. So you are going to have a little bit higher of a distribution rate at 56.84% as of December 2nd, which is quite nice. And I think these are pretty underrated in terms of ETFs and strategy. I think these are pretty solid. But of course, these are all very new products. All of these products in this income portfolio are very new. There's not much track history. These ETFs have not been out for a decade, so there is a little bit of risk associated with them because they are brand new. We don't know how they're going to perform in different types of market environments. But now, here's interesting stuff. We're comparing the total returns year to date. XDTE is up 12%, and this is with distributions reinvested. Keep in mind, I am not dripping automatically in my portfolio. I'm simply just letting the distributions just kind of sit in this little cash account. So we do have a pretty big uninvested cash amount of $18,000. And if we do take a look at our portfolio year to date, we are up 2.15%. And that is with all the drops, with ULTY, with MSTY. We did take some losses there, but overall we are positive because we have been collecting those distributions every single week or every single month, depending on the ETF. So I am pretty happy that we are not in the negative for 2025. But I will have to say the YieldMax ETFs have been hurting this portfolio the most, and there is some reasons why I'm not really planning on selling ULTY just yet. I may get rid of one of the YieldMax ones, either YMAX or YMAG, and move it to a different fund. Maybe I'll build up the NEOS funds as they have been quite reliable. But as far as total returns for XDTE and QDTE, they have pretty solid year-to-date returns for 2025, and I'm pretty happy with that. Next, we'll take a look at YMAX, which is the YieldMax Universe Fund of Option Income ETF. You are going to be getting weekly distributions, as well as quote-unquote diversified exposure. It is a fund of funds. It's going to contain all of their single stock option income ETFs. There's about 50 of them. Some of them are quite good, like the NVIDIA one or Apple. But there are a lot of meme stocks, quote unquote, in here as well, such as Coney, CRCO. They even have Carvana. So there's a lot of bad holdings in this universe fund of option income ETFs, which is one of the reasons why I do plan to probably get rid of this position, maybe throw it into WPay. I like that fund a lot better than the YieldMax ones as of right now, because you are going to get capital appreciation with that ETF. And if we take a look at the share price year to date, not looking too hot, down 37%, and it has been continuously declining, which is one of the reasons why I do have a little bit of a loss with this ETF, and I'm not really too happy with it overall. And then they also have YMAG, so it is going to contain the Magnificent Seven of their single stock option income ETFs, which is going to be Apple, Amazon, Google, Facebook, Microsoft, Nvidia, and Tesla. So it is going to have the top 7 tech companies in the United States, a little bit better, but it is going to be not as diversified as we would like to. Now, taking a look at the year to date, it's down only 23%. So I'm more of a fan of this ETF than YMAX, but it is down. It doesn't really have much of a growth to it, which is one of the flaws with a lot of these YieldMax ETFs. We want something that's not continuously declining in price. We want something that also rallies in bull markets while also providing us distributions, whether it be every single week or every single month. But here's what's interesting. For 2025, with distributions reinvested, you would actually be positive. You would be up 7.41% with distributions reinvested and 16% for YMAG, which is actually quite good considering the share price of YMAG is down 23%. But we know with our portfolio, we are not reinvesting automatically. It just goes more into our buying power. And then when we do see dips, we will buy different funds, such as adding more to WPay or SPY. But I haven't really been reinvesting back into those YieldMax ETFs, even though it does have a positive year-to-date return for 2025. And next, we're going to be talking about ULTY, which I am down on. I do have a cost basis of about $5.50. So we are down a little bit on share price. But this is the YieldMax Ultra Option Income Strategy ETF, and I am planning on holding it to see what exactly they're going to do with this ETF because they have changed it. If we take a look at the holdings, we can actually see we have a lot better holdings. We have Broadcom, we have Palantir, we have Google, we have Facebook, we have TMF, we have Bitcoin, and we also have exposure to the NASDAQ 100 and gold, Morgan Stanley. So what they're doing here is they're not choosing the most speculative companies, the most highest implied volatility stocks on the market anymore. Now they're choosing reputable companies, big market caps, things that people recognize and is likely to raise in share price over time, which in turn is going to help this ETF. But in turn, their distribution rates are going to be cut. It is going to be more around a 40% distribution rate that they're estimating previous to the 80 to 90% that they were aiming for. So even though you are getting a much less distribution rate, I think that this is going to help preserve the NAV with this ETF because we've seen a lot of these lower yielding ETFs perform a lot better when you're taking away from the yield and allowing some more room for growth and NAV stability with some of these other ETFs such as SPY, QQQI. I think NEO's ETFs have really nailed it. We can see they are still standing at a $50 price point. So a lot of people who have bought this ETF through the dips and the rallies, they are pretty happy with these ETFs. And I think one of the underrated ETFs is actually going to be BIGY by YieldMax. So I do plan probably going to replace those YMAX and YMAG ETFs with BIGY, but it is a Target 12 Big 50 Option Income ETF, 50 of the largest United States companies. And you are going to be targeting a 12% annualized yield, which does not sound like much, but if we take a look at the year-to-date chart, this is really what we want to see. It's share price appreciation in exchange for a lower yield. But this does pay out monthly. A lot of people aren't a huge fan of that, but I think this is a much safer option for the long run as you are going to have this nice share price appreciation and growth along with monthly income. Now let's go over to the NEOS ETFs, which is going to be SPY and QQQI. I'm a huge fan for these NEOS ETFs because it looks exactly like BIGY. You are going to get that share price appreciation and NAV stability with this ETF. This ETF is going to target around a 12 to 14% dividend yield paid out every single month. They are going to be coming out with some boosted NEOS ETFs, which is going to use a little bit of leverage to boost that yield a little bit. But for this ETF, it serves its purpose of 12 to 14%. And it has won the Best New Active ETF award winner for 2025 for a good reason. A lot of people love this ETF. And not only that, there's a lot of benefits with QQQI and also SPY, which is the same exact strategy, but it's on the S&P 500 index. So basically you are going to have, of course, your call option strategy to generate income, but it's going to be actively managed and also take advantage of tax loss harvesting opportunities in addition to utilizing index options classified as Section 1256 contracts, which is going to be subject to lower 60-40 tax rates, meaning 60% is going to be taxed at that long-term capital gains rate and only 40% short-term capital gains, which is very nice for people holding this in a regular taxable brokerage. And you are going to have a relatively low expense ratio of 0.68%. Now, that is higher than a lot of passively managed ETFs, but for actively managed option income focused ETFs, this is a little bit lower than competition, such as YieldMax charging over 1% expense ratio for the ETFs. And if we take a look at the total returns distributions reinvested for 2025, SPY is up 15.62% and QQQI is up 18.88%. And that is the reason why a lot of people love these NEOS ETFs. That is a solid total return for 2025. And while these ETFs have only been out for about 2 years now, it has been doing quite well as a track record. It is going to move down with the market during market crashes, market dips, as it follows the NASDAQ 100 or the S&P 500 index, but that is quite common for a lot of these ETFs. If the underlyings go down, the ETF is going to go down as well. And we also have BTCI, which is down year to date 21.5% in share price, but it's of course going to follow Bitcoin. Bitcoin has not been doing too well recently, so we do see quite a big drop in share price, which honestly may be a good buying opportunity for a lot of people who are going to be bullish on Bitcoin in the long run. And if we add this to the year-to-date return, if you are reinvesting your distributions, you are going to be positive 1.8%, even though it is down 21% in share price. So that is quite nice to see. Now, our last ETF on our list is going to be WPay, the Weekly Pay Universe ETF. This is going to be similar to YMAX, their fund-of-fund option income ETFs, but this is not going to be using options. They're generating the income using swaps and leverage, so it's a little bit different. But the pros of this strategy is it is going to have a growth potential. We can see it does have some ups and downs, but it does recover during bull markets. And that is something that a lot of people are really happy with this ETF. Even though it is down 7.81% year to date, you are going to be getting capital appreciation if the market does recover. We do want to note that this is going to be leveraged ETFs, 1.2 times leverage. So it is going to be a little bit risky, but for people who are long-term investors, they want a little bit more growth oriented. This is going to be a great weekly payer. It pays out about a 30 to 40% distribution rate. Right now it's at 38%, but you are going to be getting weekly distributions and diversification. One thing I want to note about this income focused portfolio is there's not really any single stock ETFs. A lot of them are going to be diversified. In the case of XTTE, it's going to follow the S&P 500 index. QDT is going to follow the NASDAQ 100. YMAX is a fund of funds similar to YMAG, going to contain 7 different stocks. SPY and QQQI are going to follow the S&P 500 and NASDAQ 100 indexes respectively. WPay is a fund of funds. BTCI, of course, is going to be crypto related, going to follow Bitcoin. ULTY is also a little bit diversified as well. And that's why my portfolio overall has been a little bit more stable than most other people. It's because I really focus diversification with a lot of these income funds, mainly because a lot of them are so new and single stock ETFs just has that risk factor that I'm not really willing to take. Now, if we're taking a look at the total return year to date, of course, WPay is such a new ETF. It came out September of 2025. Just 3 months ago, but so far for that duration, it's up almost 4%. So that's actually kind of crazy considering the share price is down 8%. But you have to factor in the distributions for the total return. And if you are factoring that in, you are going to be positive. So right now I have a cost average of about $50 per share, and I am positive on this position. So there you have it, the 9 ETFs currently in my portfolio. I do plan to get rid of the YieldMax ones. I am going to keep ULTY for a little bit longer just because they did change up the strategy. They're now holding some quote-unquote boomer stocks, which should help for the NAV stability, but it's also going to lower the distribution yield, which in my opinion, I'm totally okay with if they can fix that problem, because it seems like they are trying as hard as they can to address the problems with ULTY very desperately because they have been losing a ton of market share. But I am going to add more to my Niels positions, which include SPY, QQQI, and the BTCI, as well as WPay. I have been a huge fan of this, and it is at a low price point of $46 per share, so I can lower my cost average. And then I also plan on, as I mentioned earlier, adding to a new position, which is going to be BIGY. Of course, the YieldMax doesn't have the best reputation, but we can see with this ETF in the past year, it's up 5.5%. We have a nice capital appreciation with the bull markets, and you are getting a 12% annualized distribution rate. So we definitely want to see where this ETF is going to be headed, and it is pretty underrated. We see there's not much volume, only 13,000 shares traded as of last Tuesday, but I think there is a ton of potential for this ETF. So we'll definitely have to see. Let me know down in the comments below, what ETFs are you holding in your high yield income focused portfolios? And if you have any recommendations for my portfolio, definitely let me know your thoughts in the comments down below, and thanks for watching.